Hi everyone, we are now going to review a few of the problems that I suggested you practice for chapter 13. Now, I am sharing my screen right now and we are going to first look at problem 13-2. Just check something before we get started. Sorry about the hold up. Okay, so I'm on page 757. Camden Biotech began operations in September of 2021. The following selected transactions relate to liabilities of the company for September 2021 through March of 2022. Their fiscal year ends on December 31st. Its financial statements are issued in April. So the first thing they want us to do is prepare journal entries for each of these items. So let's get started. September 5th, opened checking accounts at Second Commercial Bank and negotiated a short line of credit up to $15 million at the bank's prime rate, 10.5% at the time. The company will pay no commitment fees. Well, all we're doing is signing a loan agreement here. There's no financial transaction until we actually start borrowing money on the line of credit. So remember, a line of credit is just a potential loan the company can draw from. So usually companies get these to use in their normal operations. So if they don't have enough money in their checking account to pay their bills, they could draw on the line of credit. And then when they, and borrow the money to put into their checking account. And then when they do get that extra money in, they could immediately pay off the line of credit plus any interest. Now there is no journal entry, but as noted there, it would be disclosed in a disclosure note. In B, October 1st, now the company borrowed $12 million cash from Second Commercial Bank under the line of credit and issued a 5-month promissory note. Interest at the prime rate of 10% was payable at maturity. Management planned to issue 10-year bonds in February to pay the note. Wow. So as of right now, we just debit cash and credit notes payable to show that we borrowed the money on the line of credit. And that was October 1st. Next year, we plan to sell bonds. Remember, borrow money from the public. That's what a bond is. It's when the corporation goes to the public instead of the bank and borrows money by selling pieces of paper called bonds, promising two things: interest while the bond is active and payment of the principal when the bond matures. So they're replacing one liability with another next February. C, received $2,600 of refundable deposits in December for reusable containers used to transport and store chemical-based products. So this company has it's a chemical company, and it ships chemicals in containers that are reusable. So instead of just sending a container to a customer and saying, throw it away when you're done, no, send it back, and we could reuse it. So to encourage that container to be returned, Camden Biotech requires their customers to pay a deposit on that. And then when they return the container, Biotech will pay the deposit back to the customer. So when they receive the $2,600 of deposits from the customers, they'll debit cash and credit liability refundable deposits until they actually pay the deposit back because they received the container back. For the September through December period, sales on account total $4,100,000. The state sales tax is 3% and the local sales tax is 3%. So how would we record the sales tax? Well, first of all, we will credit sales revenue for the sale amount, $4.1 million. Whether this company charges sales tax or not, their sales revenue is $4,100,000. How much in total sales tax do they have to charge the customers? Because remember, sales tax, it's on the merchandiser or the company selling the product to collect the sales tax for the state from the customer. The day they collect the sales tax, it's immediately due to the state. So they're going to credit sales tax payable for 6% of $4.1 million And then the total is what they have to collect from the customer. So accounts receivable will be debited for $4,346,000. In E, we need to accrue interest on the loan from October 1st. So we will take the $12 million that was borrowed on October 1st times the 10% interest rate times October, November, and December, 3 months of interest. So 3/12. Now the assumption here is we didn't pay any interest on this yet. So we debit interest expense for the total of $300,000, and as of today, December 31st, we owe that, so we credit interest payable. So we always must accrue for interest on any loans outstanding at the end of the year that has not been recorded. An F, in March, they pay the entire amount of the note on its March 1st due date, using proceeds from a February issuance of $10 million 10-year bonds at face value, along with other available cash. So the key here is that they're paying off the $12 million loan. They're not only paying off the $12 million principal, but also 5 months of interest. So when they originally borrowed the $12 million, it has a 10% interest rate, which will give us $1.2 million for the entire year. We need to calculate interest for 5 months because that's how long the note is for. So not only will they pay back the $12 million, but the cash also of $500,000, the interest portion. That's the interest for the entire loan. That's what they have to pay back. What will they debit? Well, you could see there, notes payable is debited for the $12 million. Yeah, now we have to reduce that account so that it's zero. We're going to reduce the interest payable for the portion of the interest that was already recorded as an expense last year. Now we're paying it. Decrease that liability, that's zero. And the 2 months of interest that did occur this year from 1/1 deposits are expected to be returned during the first 9 months of the year. Half of them were returned in March 2022. Well, the part that is returned will debit liability refundable deposits because we got the containers back. We sent the cash back to the customers, $1,300. So that's how we take care of those various liability transactions. The second part wants us to prepare the current and long-term liability sections of the December 31st, 2021 balance sheet. They also tell us trade accounts payable on that date were $252,000. So the first thing we want to note is that we will have a notes payable of $12 million. Now we're paying it off in March. Will that be current or long-term? The other liability is the refundable deposits. And they tell us half of them were returned by March of the following year, and by the end of the year, all of them would be returned. Sales tax is another liability, and interest payable. So the question becomes, which of these are current and which are long-term? Take a look. Excuse me. Accounts payable is always current. The refunds deposit liability is current. Sales tax payable is current, and the interest payable. But what about that note payable? Well, if we were just going to pay off the entire $12 million of note payable with cash, it would have all been current because it would have been paid off by March of the next year. But because we're using money from a long-term debt, okay, bonds payable, that will be sold next year to pay off the $10 million next year, we're actually refinancing this loan. $10 million of it with the long-term debt, bonds payable. So $10 million of the note, the part that's being refinanced with the long-term debt, will still be considered long-term, even though it's being paid off next year. And the $2 million excess that actually is being paid off with cash, that's not from the debt, from the bond, because only $10 million bonds are being sold, is considered current portion of notes payable. So we got to be careful when we're refinancing debt. If we're refinancing it with a long-term debt, it still maintains its long-term character. Okay, 13.6. Now we're going to go on to various contingencies, another component of liabilities. Eastern Manufacturing is involved with several situations that possibly involve contingencies. Each is described below. Eastern's fiscal year ends December 31st, and the 2021 financial statements are issued on March 15th, 2022. Determine the appropriate way to report each situation. So, is a journal entry required, or just a note, or do we do nothing? And that, remember, depends on how the contingent liability is described. If it's probable, we're going to be doing, and we can estimate it, we're going to be doing a journal entry. If we can't estimate it, or it's reasonably possible, that's a note to the financial statement. And if it's remote, we don't do anything. So in A, Eastern is involved in a lawsuit, which is the most common type of contingency, resulting from a dispute with the supplier. On February 3rd, 2022, judgment was rendered against Eastern, so the next year, in the amount of $107 million plus interest, a total of $122 million. Eastern plans to appeal the judgment and is unable to predict its outcome, though it is not expected to have a material adverse effect on the company. This is a contingency loss. Eastern can use the information occurring after the year end in determining appropriate disclosure. It is unlikely that Eastern would choose to accrue this because the judgment will be appealed and they're not sure about that outcome. So this would just be a note to the financial statement. It's reasonably possible. And that's the common type of note that would be written. In B, in November 2020, the state of Nevada filed suit against the company seeking civil penalties and injunctive relief for violation of environmental laws regulating hazardous waste. Now, on January 12th, 2022, Eastern reached a settlement with the state authorities. Based upon discussions with legal counsel, the company feels it is probable the $140 million will be required to cover the cost of violations. Eastern believes that the ultimate settlement of this case will not have a material effect on the company, adverse effect. This is a loss contingency, and Eastern should create the following journal entry. It's probable, and they could estimate it. So they're going to, on December 31st, 2021, debit loss litigation, and credit a litigation payable or liability litigation liability account, and disclose this in a note to the financial statement. Eastern is the plaintiff in a $200 million lawsuit against the United States for damages due to lost profits from rejected contracts and for unpaid receivables. The case is in final appeal, and legal counsel advises that it is probable that they will prevail and be awarded $100 million. Don't do anything. This is a gain contingency. Gains could be noted in the footnotes in the notes to the financial statements, but there's no type of accrual for a gain, only losses, because we take a conservative approach to reporting financial information. At March 15th, Eastern knows a competitor has threatened litigation due to patent infringement. The competitor has not filed a lawsuit. Well, guess what? Nothing's happened. You don't do anything. Okay. There is no lawsuit, and it is not probable that a claim will be asserted in the future. Okay. And you could read on with that. So just some practice with contingencies. The final problem we're going to look at is P1313, which relates to payroll. Alamar Petroleum Company offers its employees the option of contributing retirement funds up to 5% of their salaries, with the contribution being matched by Alamar. The company also pays 80% of medical and life insurance premiums. Deductions related to these plans and other payroll information for the first biweekly payroll period of February are as follows. So wages and salaries are gross pays. Then we have the voluntary contribution to retirement plan, medical insurance, life insurance premiums, federal income taxes, local income taxes, and then the rates on various other taxes that the employer has to pay. So we need to prepare the appropriate journal entries for the payroll being recorded and the payroll taxes being recorded. So let's take a look here. There we go. So let's first look at how will the company record the payroll. This is how the paycheck of the employees. Wages and salaries expense is debited for $2 million. That is the gross pay. That is what all the employees together that first week of February are entitled to. That's what they earned. $400,000 was withheld from this as required by law to pay federal income tax of the employees. The company appropriately credits a withholding taxes payable or federal income tax payable account, because all the employer is required to do is not pay that money of the $2 million, not pay that to the employee, but send it right to the government on the employee's behalf. So the day they withhold it, the company withholds it from the employee's paycheck, it becomes a liability to the company. They owe it. Withholding taxes for local taxes. It's the same thought process there. We credit a local tax payable for $53,000. Social Security tax. Assume all the cumulative wages do not exceed the relevant wage base for Social Security. Good. So all $2 million is subject to the 6.2% Social Security tax, which is another federal tax. Employer doesn't pay the employee, sends it off to the federal government. 2 million times 6.2%, the employer is going to credit their Social Security taxes payable. Medicare tax is the other side of the FICA tax. Take the full amount no matter what times 1.45%. All $29,000 is taken out of the employee's paycheck. The employer holds it in a liability account until they pay it to the federal government. So those are your mandatory required by law deductions. As an employer, you have to take those out of an employee's paycheck. Medical insurance, the premiums of $42,000, 20% of them are paid by the employees, so 20% are withheld and credited to medical insurance payable, $8,400. Same with life insurance. We'll take the $9 million total premium, 20% of that is withheld out of the employee's paycheck, so we'll credit life insurance payable, $1,800. The employees in total contributed $84,000 into their retirement from their gross pay. So the employer withholds that and credits retirement plan payable $84,000. So the employer creates a liability for each withholding until the employer ultimately pays that money to the required area. And that's all based on who gets the money. So the government has scheduled times that they get money. Same with the life insurance company and the health insurance company and the retirement plan. They're going to let the company know, hey, you've got to send some money into us. When we're recording the paycheck, though, we take the $2 million gross pay, subtract all those withholdings, and that's ultimately the net pay that gets paid to the employees. We credit that to salaries payable until we ultimately write the payroll checks out to the employees. The next item we need to calculate are payroll taxes. Now remember, a payroll tax expense is a special tax put on the employer because they have employees. There's 4 taxes that would be in this category, if applicable. The first 2 are a match of what the employee pays. So whatever the employee has withheld, the employer must match that amount and pay it out of their own pocket. So Social Security taxes payable matched at $124,000. So when the employer pays Social Security taxes for this payroll, they're not just paying $124,000, they're paying $248,000 in total. $124,000 came from the employees, $124,000 comes from them. Same with Medicare taxes, those are matched. So whatever the employees pay in, $29,000, the employer matches and pays in as well. Now the other 2 taxes are unemployment for state and unemployment for federal. But if you take a look at the last sentence under the requirements, it says, assume that all employees' cumulative wages do exceed the relevant unemployment wage basis at the end of January. If you remember, employers compute these 2 taxes on employees' gross pay, but they don't have to use all of their gross pay for the year. They only calculate tax on using an employee's gross pay up to $7,000. So what this statement is saying is all employees have made that $7,000. So none of the gross pay going forward or as of today is used to calculate unemployment taxes. So the employer doesn't have any. So, and that could happen. So at this point, the total payroll tax expense is just the Social Security and Medicare. So we debit an additional expense, $153,000. The final journal entry relates to fringe benefits. And a lot of times companies don't debit a salaries expense. They'll debit employee benefit expense, because these are not truly salaries being paid to the employee. These are extra amounts paid on the employee's behalf for services for the employee. What would be included here? Well, the medical insurance, the other 80%. So the company will credit medical insurance payable for that 80% of $42,000. So that's what the employer is going to pay towards the medical insurance. Same with the life insurance. They're going to pay $7,200 or 80% of the total premium of $9,000. And then they match, it says up in the top there, anything the employees pay in, the employer matches. So the employer will take out of their pocket an additional $84,000. So these 3 amounts are even more of an expense to the employer because they offer the employees these extra amounts beyond their gross pay. So we debit an expense account for their total. Notice these credits are all in payable accounts. So as we pay them, we would reduce the payable and decrease cash. So that's a great review of the payroll portion, and that was in the appendix, and you want to make sure you know how to do that. Okay, so that concludes our review of some of the problems in Chapter 13. Please post any questions you may have to the discussion board.